Hello and welcome to this Friday's morning market briefing. We've got lots to talk about. Firstly, banks and other financial institutions are standing up to the EU's financial plans to do with derivatives. As well as that, we've got lots to talk about to do with Germany's possible economic slump, with their car making manufacturing sector falling and declining in line with other issues with the global economy, such as China and interest rates. As well as that, Bitcoin's on the rise on the charts. Pound yen's in an interesting position, and we've got lots of economic data coming out today, including Japanese growth rate to do with GDP, as well as Canadian employment figures. So we'll get straight into it, and we can talk about this first article, being which banks and investors step up opposition to EU's derivative plans. Now, asset management firms and other independent financial institutions on Thursday across Europe have stepped up their opposition to EU's plans to shift trillions of euro derivatives out of London. Now, as we know, the UK used to be a part of the EU, and with that, the UK has a large financial service sector, and as a result holds a lot of the derivatives, and also is involved in a lot of the transactions to do with derivatives. And therefore, now that the UK's left the EU for some time now, there's still some of this backlog of the UK handling a lot of the EU's transactions to do with derivatives, and we'll come to that now. The main justification of the EU to move away the derivatives from the UK is that it could hurt. The main justification from asset managers and banks that they shouldn't make this move and move the derivatives from the UK to the EU is that this move could hurt European companies and investors, with 11 trade associations saying they strongly recommend policymakers don't push a minimum amount of euro derivatives through so-called active accounts held at EU-based clearinghouses. Now, clearinghouses are effectively they sit between counterparties on deals and prevent defaults from cascading through the financial system. So they're kind of involved in all of these EU derivatives transactions and that sort of thing. Now, the vast majority of the global business for euro derivatives, however, is handled in the London's cleaning house, leading EU politicians to be unhappy about their regulators not having direct oversight, as this is all handled on the UK side. Now, London's clearinghouse manages more than 90% of the global market, so they have a large amount of control over these EU derivatives in terms of managing their transactions. Now, the planned EU move would be to move this London cleaning house to Germany for the EU derivatives transactions. However, the majority of businesses have stayed in London due to the high cost of transferring derivatives positions, which would end up running into the several billion euros mark if they did end up transferring these derivatives. That said, the EU still just wants to reduce the EU's reliance on the UK's financial services after Brexit. So once again, coming out of Brexit, we have another one of these kind of trade-off scenarios with the EU and the UK kind of wanting to have more sovereignty over their own issues and their own sectors and financial institutions, but the economic cost that comes with that and how that might affect the markets coming with these policy decisions. But at the moment, it seems like most German financial institutions really do not want this to take place, largely just due to the fact of how much it will cost and how much the UK already looks after. It kind of seems like it's not worth it to these large financial institutions. But moving on from that, we stay within the Eurozone to talk about Germany's industrial gloom and doom kind of scenario. So, a falling car making fueled a downturn in the German industry as production fell for the third consecutive month in July. Now, we know many countries across the globe coming out of COVID and with the issues with the Russo-Ukraine war on energy prices is struggling with production, which is heavily energy reliant. Now, Germany prides themselves on their economy of production, and so kind of seeing this fall in productions, very significant for such a country that depends on it. Now, German production fell by 0.8% on a month on month, as production fell for a third consecutive month in July, as I said. But this is coming in worse than the 0.5% forecast. So even with a negative forecast of 0.5%, we're still seeing a decline in production by 0.8. Now, this figure would also have been far worse had there not been a rebound in energy and construction output in July. And so this is still a tame figure in terms of the actual conditions, putting into perspective how really bad it is within the German production sector at the moment. Now, with the German car making production sector falling by 9%, so far worse than any 0.0 figures or whatever. The German economy has either shrunk or stagnated for the past 3 quarters, and its recovery from COVID is slower than the US or the overall Eurozone. So despite Germany being the industrial powerhouse that it is and the leader within the EU, it seems, and the Eurozone as a whole, as well as that in the global sphere, it still seems that that Germany is really struggling from these current economic issues, external economic issues really, with the cause of the industrial decline largely being at fault of the higher energy prices and rising interest rates with the slowdown of trade with China. Now, we spoke about China a lot this week, and largely to do with their decline as well, their lack of production and their weak demand following a series of economic issues within China itself coming out of COVID. And so we're really starting to see this kind of chain of damage that comes out of one large country having falling demand or falling production, and the effects that this has on other countries which rely on that, with Germany, I think, having China as its second largest export market. And so any falls to do with Chinese demand due to their economic conditions is going to heavily affect Germany, which is so export dependent, to do with manufacturing, that sort of thing. So we're really starting to see this kind of chain of destruction that the decline of China's demand is showing in other countries. And I worded that poorly, but I think you get the gist. That this decline in manufacturing has led many to believe that there will be a contraction of Germany's economy in the second half of the year. And now this is coming after many people are kind of hoping within this second year of 2023 that the global economy will start to try and bounce back despite its issues. I know we spoke about on the other day about the warnings that have been put out to the G20 members from the FSB to do with the global economy and the issues that it still has and the lack of growth that we're likely to see. But despite that, it's still looking far more optimistic for certain countries than Germany, it seems. And having a decline in the second year will obviously be very detrimental to the EU as a whole, with the EU Statistics Office cutting the Eurozone growth projections in the second quarter from 0.3% to 0.1%. So we're really starting to see how Germany and their decline is also just affecting the Eurozone as a whole. And so it'd be interesting to see if by the time that we actually reach the end of this second quarter, we'll actually be seeing a decline. Reach the end of the third quarter of this year, that they'll even bring the projection, the estimation, even lower than 0.1% of growth, which would obviously be extremely detrimental to Europe as a whole. There are also worries of German industrial groups shifting production abroad, as they're experiencing these issues, especially to do with higher energy prices. However, Olaf Scholz, the German Chancellor, has vowed to boost growth and banish extensive bureaucracy. But it's how effective this will actually be that matters. Schultz, however, has opposed the idea to subsidize electricity prices for high intensive industries, which is industries such as manufacturing, especially car manufacturing, which relies heavily on energy, and so any energy price increases, that's going to heavily affect the car manufacturing sector. This was proposed by the Green Party. However, Schultz has opposed this idea and instead is looking to just try and get rid of extensive bureaucracy and just boost growth somehow. With, as I said, the most energy intensive industries seeing the largest decline recently following Russia's invasion into Ukraine, the energy price spike that's come out of that. And it will also be interesting to see how kind of these declines within certain economies following such high inflation, an increase in rates, geopolitical issues, and now we're seeing declines in many economies, especially with large industries like car manufacturing in Germany. It'll be interesting to see how this will actually affect the political sphere as well in Germany and other countries around Europe that heavily rely on this energy from Russia. But that's it for the articles. We can now move on to the charts. There's stuff to talk about on the charts, certainly. The first thing to talk about to do with the charts, I guess, is how US indices have declined, as we spoke about over the past few days, as we expected this following the US jobs release, as well as the talks around interest rates. But we're also, able to use this opportunity of a retracement to kind of get in lower on these US indices. As we can see here, I've drawn out, the Fibonacci with some areas where it seems like there's high areas of liquidity with support. Obviously, it's punched through here, but these were areas marked out, at the start of the week, and it's kind of interesting to see how it's sort of come down and found its liquidity around this level. So it would be interesting to see whether US 30 can actually make a bounce back over next week and see if it can make any gains following reaching these areas of higher liquidity. As we can see here, this is where there's been accumulation before, and so we know institutions have used this area before to place orders. Going to US 100, we haven't seen at all any of that retracement to the upside that we kind of have seen on we haven't seen any of that kind of bounce back on the US 100, unlike what we've seen on the Dow Jones. That said, it hasn't fallen as much as the Dow Jones, and similar to the Dow Jones, the S&P 500 sort of found some liquidity somewhere around this 4432 mark and is kind of making a push higher, but we'll see if it can actually make any gains. As you can see here, it's not really making any higher highs, so I would keep your eye on US indices for an opportunity possibly to the upside, a long-term opportunity to the upside. But next to talk about is the dollar, which continues to rally. Now at the start of this week, I remember drawing out this previous high area coming out of the employment data last week. We've seen the dollar rally and push for higher highs. Now the question is, how long can it kind of keep this run going? As we can see here on the RSI, it seems as if the dollar's overbought, and whenever the dollar goes down, gold goes up, and all these other pairs are so affected by the dollar, including bonds and all other commodities. So it'll be interesting to see whether now the dollar's kind of becoming overextended, it's broken above these highs, will it retrace as it's in an area of kind of inflation? Well, not inflation, but it's overbought. So it'd be interesting to see whether it will now retrace back down to another level. If we draw out the Fibonacci here, Fibonacci retracement tool here, we can kind of put on the most key levels and kind of see where it might fall back down to. If it's only going to make a short stop, it could always just reach this lower low that it's made recently, or if it's looking for a greater level of liquidity, it could obviously run down to these 38.2 levels or 50% levels. I think it's quite unlikely it would run down to the 61.8 level and continue rallying, just considering the economic conditions at the moment and kind of the uncertainties. Moving on from the dollar, we have dollar pairs to talk about, such as Euro USD. Now, we also had this area of liquidity drawn out since the start of the week that we said if the dollar makes gains, it's likely that we're going to see it run down here. Now, yesterday we saw European GDP growth come out, and that was far more negative than expected. And in line with that, we've seen euro dollar kind of fall off, pushing its way towards this area of liquidity. So it'll be interesting to see whether euro dollar can reach that level and whether it will then use this area of liquidity to move higher possibly, or the strong dollar news and the weak euro news might just allow the euro to break lower. Moving on from that, we've got GBP JPY. Now, this has kind of been bouncing around different areas of support and resistance, different areas of liquidity recently, as we can see here, this kind of purple box I've drawn out, and also this purple box I've drawn out, rectangle, sorry. And it's kind of been bouncing around this area. It rallied for a bit, but it couldn't find any gains and fell to the downside to reach this area of liquidity. So it'll be interesting now it's testing this area of support again, whether it will bounce once again off to rally once more, or in fact it will make another push to the downside to reach the bottom of this kind of channel that I've drawn out here before making another possible gain. As we can see here, it's kind of a pretty strong channel. And so it'll be interesting to see whether it will actually use this liquidity to move up again, or it's just time for pound yen to break lower. Now, keeping on the topic of the yen, as we know, we've got yen news coming out today to do with their GDP growth, and so we've sort of seen this double top form on USD JPY. As we know, that often means that it's time for a reversal. However, with economic data coming out, these kind of technical analysis tools and price action patterns kind of become a bit more irrelevant when you've got high impact economic data coming out. So despite the fact that we've seen this double top, it'll be interesting to see whether with this data coming out we might see a spike to the downside before a rally higher on the USD JPY, or in fact it will make a fall to the downside. So keep your eye on the USD JPY with this high impact data coming out. But by the time you watch this, the data will already be out, so you'll be trading that. We've also seen a Bitcoin rally really recently. It's kind of been sitting around this area, just consolidating, not doing much, but it's kind of made a peak higher here, trying to break out this kind of area of consolidation. But we'll see whether Bitcoin can actually make any gains off that, or it might just reverse to the downside further. I mean, if we draw out a Fibonacci retracement tool, it's kind of on from the previous high to the lowest low. I mean, it's just reached the 38.2 area, and now it's looking like it's about to turn around. But once again, by the time you're watching this, you'll have a better view on Bitcoin than I'm able to look at now. So it'll be interesting to see whether Bitcoin will stay in this area of consolidation, or it's finally going to make a break higher, coming out of the recent SEC news that caused this rally higher and then this push to the downside again. But aside from that, we've got gold to talk about, which is sort of hanging in the balance. It was on this rally for a while, but now it's broken below this trend line, and it's kind of hovering around these different areas of liquidity and at this 50% Fibonacci mark. So it'll be interesting to see whether now it's at a higher level of liquidity and kind of this 50% Fibonacci mark, it will actually make a push higher, or in fact, due to any dollar news, it might make a push lower. But we'll see about that. But that's it for the charts. We can now move on to data that's coming out today. The first bit of data being Japanese GDP growth rate for the second quarter of this year. Now it's forecast to be 5.5%, but obviously whatever figure this comes out with, it will greatly affect the charts in relation to the yen. And we've also got other, yen related figures of medium significance coming out. As well as that, we've got the German inflation rate coming out. So that'll be, as we're speaking about Germany's production sector, it'll be interesting to see how, declines in production might have affected inflation. And obviously, if you're looking at trading any euro pairs, any inflation rate in, the leading EU economy is obviously going to have a great effect. But staying on the topic of the Eurozone, we've got French industrial production coming out as well. So as I just spoke about, to do with Germany's industrial production, it'll be interesting to see how a neighbouring country like France is also being affected with industrial production. And second to last, we've also got Canadian employment data coming out. So, some high significance data, but it'll be interesting to see how this will come out following last week's US employment data, which ended up being more positive than expected. So keep your eyes on that. And then finally, we've just got United States wholesale inventories data coming out. So quite a lot of high impact data actually coming out today, and quite a lot of medium impact data as well. But I think we've spoken about a lot of important things that might be affecting the charts today. But once the charts close this evening, have a nice weekend, and I hope you have a great trading week next week as well. But yeah, have a great trading day. See you later. Bye.